Startups are in a much worse shape now than what was believed as per Kroll. Instacart, a grocery delivery provider, has cut its valuation from $39 billion to $24 billion in March and from $24 billion to $13 billion in October as per PitchBook. Well, this has also pushed down market prices for comparable companies like DoorDash by nearly 50%. Now you might be wondering, why did Instacart make its valuation cut public? The answer is simple. Private companies in the US have to conduct a valuation exercise every year basis the fair market value, and if that results into a lower number, they have different ways for addressing the valuation cut to the public. One, it is done to not convey a distorted valuation picture to the potential retail investors who might invest in the company's IPO basis the actual financial performance. Second, to make it look publicly appealing, companies justify valuation cut for recruitment, as the stock options given now will be available at a lower valuation and a cheaper price, which will result in a bigger payout for employees when the company goes public or gets acquired. But what happens to those employees whose existing stocks are valued lesser now? The company addresses this in two ways. First, they could give employees more grants this year to compensate for the worthless options, or second, they can also reprice the existing options or cancel them and issue new ones at a lower price. This example of Instacart comes in the backdrop of internal valuations or 409A valuation that talks about offering equity to employees on a tax-free basis. In other words, a 409A valuation is an independent assessment of the fair market value of a private company's common stock. These valuations are set by third parties and not startups or their venture investors. Every private company in the US has to conduct a 409A valuation once in 12 months or before that period if there is any material change in the company. A handful of companies recently, along with Instacart, had their 409A valuations slashed by 40 to 50% as per PitchBook. Now, if you're a startup owner and are listening to this, you might be wondering if this 409A principle applies to you. The answer is yes, only if you are a US tax resident or a non-resident of the United States who earns income or compensation from the US market. It is important to note here that the 409A valuations are separate from the valuations of equity that is given to VCs in the funding rounds. Know more about this concept and watch out for how LPs and GPs of funds value their holdings when the valuations are repriced. Stay tuned as we speak with investment bankers and lawyers to give you a real-world picture of this.
Well, I mean, I think we have a live example right now, Twitter, right? And so we, I can't say that I know all the inner details, but everyone is familiar with what happened, right? The company, was on the stock price, in fact, rose significantly over the last sort of year or two during the pandemic. And in fact, rose, I think, from $20 to $54, 44, whatever the final, $54, I think, was the final price that the board agreed to sell those shares to Elon Musk, right? And so that was hammered out between the two. And that's the price. The public figures, $44 billion was paid. And I think that was at a $54 price. Mm-hmm. Now the question, although many employees have been terminated at the company, which is all public information, but the question in that company now is there's a significant material event, right? The company was delisted, taken private. The company, half the staff has been terminated. Now at what point, are the options that let's say you had people being given options at the earlier price, it was $54 a share, at least in the public markets. What were those options? Were issued at $30, $40 maybe. Now, if the valuation has dramatically dropped in order to retain those employees, and maybe the idea is to let some more go. I don't know, but the question is, will those have to be repriced? So I think there's a lot of interesting dynamics that even in the real world, right now we see playing out. It'll be very interesting to see what happens.
So Anand, tell me, what was the origination of 409A? How did it even come into existence in the United States?
Right. So essentially, somewhere early 2000, during the startup boom, a lot of companies, started issuing stock options to their employees at like really low prices. So, what used to happen was, obviously, there was a lot of taxation issues that arose that, okay, if an employee is getting a stock option at a cent, say, for example, for a stock whose price is actually $1 at that point in time, when should he be taxed? Should he be taxed at the time of the grant, or should he be taxed when it's exercised? Because if you consider, he's already made some money, right? From 1 cent to $1, it's something that he's already made today. So that's where, IRS kind of framed up the 409 regulations, where it essentially states that if an employee is issued stock options with an exercise price which is lower than the fair market value of the common stock as on the date of the grant, then he will be taxed on the date of the grant an amount which is equal to the difference between the fair value and the exercise price. However, if the stock options are issued at a price which is equal to or greater than the fair market value, then the taxation event is postponed to a time when the employee actually exercises the stock options.
And practically looking at some case studies, are companies who are having low valuation with 409A are issuing stock prices at lower prices? Is that what you are seeing in the market?
So, especially recently due to the market scenario, the Ukraine war and the oil prices, a lot of companies have seen their fundamental valuations fall, because the multiples have fallen. They've not been able to expand at the pace at which they expected to. So whether have they started issuing options at a price which was lower than the previous options? Yes, they have.